Hi there, welcome to Kneppy Invest. I am excited to do today's video because I am a big fan of this company, Lovisa. And even though I will never go into a Lovisa store, and on occasion I will walk past one and have a look inside just to see how many people are within the store, I am a big fan of their business model. Now, if you do go past a Lovisa store or even go into a Lovisa store, you'll notice how small it is. And this company has some of the highest gross margins you'll see for a retail company. I think one of those reasons it has really high gross margins is they can, put a pretty good markup on their products they do sell, is because of the efficient size and operations of their individual stores. That's only my opinion. I could be completely wrong on that. Now, for those who don't know, Lovisa sells jewelry and accessories. And personally, I don't wear any jewelry or accessories, so I actually never go into a Lovisa store. But that doesn't mean I can't admire the management of this company. I also like the recent hire of their CEO, which I'll talk about later in the video. And I'm also a massive fan of the international expansion of this company. So there is a pretty long runway of growth for Lovisa over the next decade, even possibly longer than that. So I think I've already given this away. I am a shareholder of Lovisa, and I hope to be a long-term shareholder of this company. In fact, if I ever see the share price pull back a significant amount, even though I do think the valuation is a little bit stretched, I probably will add to my position simply because of my admiration for this company and for the fact that I do think there is potential for significant growth over the next few decades for this company. Maybe one day I will go into a Lovisa store, but right now I am content just walking past, just seeing how much customers or how many customers are in the store. And this sort of thing has worked out for me in the past. So about 7, 8 years ago, when Dick Smith was an ASX listed company, I would walk past the Dick Smith store and then go past the JB Hi-Fi store just to see the difference. And it was a stark difference between those two stores. Like Dick Smith was sort of like a morgue. There was no one alive in there, while JB Hi-Fi was just full of life, so much activity, that sort of thing. And I also have a pretty high opinion of JB Hi-Fi, had a fairly small opinion of Dick Smith, and then Dick Smith went out of business. Anyway, on to Lovisa. Most of the times when I go past a Lovisa store, they're small storefronts or whatever you call it, quite a few customers in there. That's a good sign. But this is a global company. When I say global company, I mean have stores all around the world, maybe not all around the world, but in 25 countries. They have 629 stores. Then they're continuing to expand. They've opened up one new European market, I think that's Poland, and one new North America market, or they say American market here. I believe that is Canada. But a massive expansion in the United States. They've almost doubled the amount of stores in that country, which might not sound impressive because maybe they started with 2 stores and now have 4. But they started off with 63 stores and have now something like 118. So let's have a look at their store count around the world. This is very important for me. I like to see where they are expanding to. So at this point in time, the biggest market is Australia with 154 stores, but maybe they have reached maturity in this country because they've only added one new store in Australia during the last financial year. But United States have grown their store count from 63 to 118. And this is one of the reasons I do think there is potential for significant growth for this company over the next few decades, particularly if they concentrate on the United States, increasing the store number there, and then continue expanding in Europe, because they do have quite a few stores in Europe. In fact, France have increased stores there from 52 to 59. South Africa coming in third with the amount of stores from 64 to 69. They also have 42 stores in UK, 40 in Germany, 32 Malaysia, 25 New Zealand, 17 Singapore, 11 Belgium, 6 Switzerland. In fact, the amount of Switzerland stores has decreased. 3 in Austria, 2 in Luxembourg, 1 new store in Poland, that's their initial store in Poland, and 1 store in Canada, and they have entered the Canadian market. They also have franchise, seems like they have a franchise model in the Middle East with 44 franchises in that part of the world. I'm a pretty big fan of the recent hire of Victor Herrero as the CEO on the 14th of October 2021. Can you say that's recent? That's almost 18 months. we'll say 16 months or so. But he has extensive experience in retail, really starting off with Index or Inditex. I've never heard of that company. He was head of Asia Pacific from 2003 to 2015, based in Shanghai and Hong Kong. Then he was a CEO and director of Guess between 2015 and 2019, and then he became the chairman and CEO of Clark's for 1 year in 2021, and then he became the CEO of Lovisa. So extensive experience within retail, and I am a pretty big fan of this particular hire. Now onto the quality of Lovisa, and for the very fact that I am willing to hold on to this company for the next decade, or hopefully for the next decade, probably is a good clue that I consider Lovisa to be a high quality company. Now, in terms of retail companies, it's one of the highest quality companies, in my opinion, and one of the reasons behind that is the high gross margins. We'll look into that in the next few slides, but definitely Lovisa is a high quality company, and you do have to pay for it. Valuation of this company is quite high, but there have been periods over the past few years where the market has been a little bit unsure about this company. We have seen the share price take a massive dip at least twice, particularly in the first few years after they did list. Maybe not the first few years, but I can remember back just after they listed, the share price took a massive plunge, and that did represent really good value if you thought highly of this company back then. I had not done any research at that point in time. I wish I had, because that was really good value. We'll have a look at the chart later in the video, and you'll better see what I'm talking about. Now onto some of their financial year 22 results, and this company will be releasing their half-year results, I believe, on the February the 22nd. I'm recording this video on Thursday, February the 16th, so we're talking about Wednesday of next week from when I'm recording this video, and I do have that day off, and I will be looking forward to their results. At a share price of $24.43, this company has a market cap of $2.6 billion. And I've already mentioned, if you do want to hold this company right now, you will have to pay for it. The main reason behind that is because I think the Australian investors and the Australian investing community believes this company is a high quality company. Not only a high quality company, probably one of the highest quality retail companies on the ASX. Revenue financial year 22, 458 million, really impressive growth in revenue, profit and cash flow. Profit of 58.4 million, operating cash flow 82.2, and free cash flow 44.8. Now on to some of the reasons why I do consider this company to be high quality, and we have seen a considerable growth in their revenue over the past 10 years. In fact, in 2012, before they were a listed company on the ASX, Lovisa only had $40 million of revenue, and they've increased that from 40 million all the way up to 458.7 million. Some of that might have been, well, some of that definitely is through the opening of new stores, but like-for-like sales have grown. But you can just see that massive growth in revenue from 288 million to 459 million in the last financial year. And the other thing I've included on this is gross margins. Really high gross margins. In fact, a couple of years here, 2018, 2019, they had gross margins above 80%, which is unusual for retail companies. So I do like to calculate or look at revenue per share growth. And my benchmark is at least 10% growth per year on revenue. And if a company can maintain their margins, that means the valuation and the profit should be increasing at 10% per year. That's not including multiple expansion or contraction. And for Lovisa, because they have not been a listed company for over 10 years, we only have a 5 and 3 year compound annual growth in revenue. But over the last 5 years, it's 17% per year. And over the last 3 years, a little bit of an acceleration, 22.5% growth in revenue. And that's another reason why I think you do have to pay for this company, because not only has this company seen pretty good growth over the last 5 years, I think that growth in revenue will continue. And if margins can be maintained between about 75 and 80%, possibly even rising above 80%, I think you will see the valuation of this company continue to grow. I could be wrong, but I think there is a pretty good chance that's going to happen. So this is the gross margin for retail companies throughout the world, not only Australia, but throughout the world. Not many companies have a gross margin above 67%, let alone Lovisa, which has a gross margin around 80%. So the majority of retail companies have gross margins between about 20% and 40%, and Lovisa is almost double that. One thing I always look at is revenue in different geographies or different products, if a company has that or services. And this is from their note A2, a revenue distribution for Lovisa. So Australia and New Zealand by far is their largest market. But even though stores didn't increase by all that much, I think one in Australia, can't remember how many stores increased in New Zealand, Lovisa did see the revenue grow. So there was pretty good like-for-like sale growth in Australia and New Zealand from 157 million to 174 million, and really good growth again in Americas because of that substantial growth in store numbers. So Americas revenue growth from 37.7 million or 37.6 million to 72 million. Europe saw their revenue grow from 40 million to 140 million, and overall really good growth for Lovisa over the past year. And I don't think we'll see that sort of growth again over the next few years, but I will expect continued growth for this company. The other thing to take into account is jewelry. I don't think is as discretionary as some other things out there, other retails. And I think a lot of, particularly jewelry, is aimed towards young women, that sort of thing, women who don't have mortgages. And I think those won't be stressed by mortgage stress. So more than likely, Lovisa won't be quite as harmed as a decrease in discretionary spending as some other retail companies out there. Another sign of a high quality company is a continued growth in dividends over time. Now, I do know some income investors like those companies that have really high dividend yield. But one thing they're missing out on is if you buy into a company like Lovisa, who only has a dividend yield of 2.7%, more than likely their dividend is going to rise. So it won't be long before the dividend yield of this company is going to be the same as those companies like Telstra and the banks who don't see much rise in their dividends, if any rise at all. In fact, I think Telstra decreased their dividend. So a really big increase in dividends for Lovisa since they listed on the ASX from something like 13 or 14 cents all the way up to almost 76 cents, 37 cents in the most latest dividend, and 74 cents for the full year. So a rapid increase in dividends. I don't care about the franking, it says 30% franking year. That's not what drives me to take a position in a company, and I don't really care about the dividend yield. It's just a fact that if you take a position in this company, particularly if share price pulls back, your dividend yield more than likely will be quite high in the future because these dividends will more than likely rise. Now, when I say more than likely, there is a chance they will fall because something bad might happen. Who knows? It could be some black swan event. But more than likely, dividends will rise through time, which means based off your initial investment, your dividend yield will increase as well through time. But if you do want to take a position right now in Lovisa, you do have to pay P ratio of 44.5, price to sales ratio 5.7. Main reason behind that high price to sales ratio is because of their really high gross margins. Price to operating cash flow a little bit lower at 31.6. But typically, I like to see that number less than 10 or even less than 15 for a high, maybe less than 20 for a high growth company. Now, I did do a reverse DCF based off the earnings per share, not the operating cash flow. And to justify the current valuation, Lovisa will have to grow the earnings per share at 24.2% per year, which I think is on the high side. So again, I think there is that possibility that this company is a little bit overvalued right now. But if I do see any pullback in the share price and any significant pullback in the share price, I am willing to significantly add to my position at any significant pullback. Now, mind you, I just mentioned that it does look overvalued, but if you look at the price operating cash flow of Lovisa, and even though in the previous slide I use earnings per share as a proxy for their reverse or for the reverse DCF, if you do look at the price operating cash flow history for Lovisa, right now at just over 20, and this is based off different calculations, how Lovisa and other services will calculate their operating cash flow. I am a little bit more conservative when I calculate operating cash flow and free cash flow because I always include leases, and most places and companies don't include leases. In fact, all companies and places don't include leases. So that's why in this particular slide, it says Lovisa's price operating cash flow is around 20.5. But it doesn't matter. What I'm doing here is just comparing the current price operating cash flow through the history. Now, there was a change in accounting standards that could have had an effect on this price operating cash flow prior to about 2019. I believe that's when those accounting standards comes in. But if it doesn't, if it's sort of comparable prior to those accounting standards to now, you might argue with me, and you could be successful, that the price operating cash flow or the valuation of this company is not too stretched right now. In fact, it's sort of in the middle between the top end of the range, which is about 32.5, and the bottom end of the range, which is around a 5. And that was found during the COVID-19 financial panic. I just wish I took a position in Lovisa back then. So probably not expensive or not cheap based off this price operating cash flow history of Lovisa. Another really good sign of a high quality company is just by the charts. What you want to see in the charts of a company, and this is the weekly chart for Lovisa going back to when I listed on the ASX, which was back in 2016, 2015, if I remember correctly. And anyway, 2014, in fact, end of 2014. And what you want to see for a high quality company is chart going from the bottom left to the top right. Share price increasing through time. But you'll notice here there have been periods of time when there's been a significant decrease in the share price. The first significant decrease in share price was way back in 2016, when the share price went from almost $4 all the way down to $2, so almost a 50% decrease in share price. Seems like that happened in 1 week or maybe 2 weeks, and then the market realized there was probably nothing. And then we also saw another significant decrease in the share price back in 2018. Share price went from about $12.50 all the way down to under $6. So another 50% correction in Lovisa's share price. And then the last two significant decreases in share price happened during the COVID-19 financial panic, and the share price fell from about $12 again all the way down to about $3. But that was understandable because most companies saw a significant decrease in the share price. But we also saw a significant correction in the share price back in the first half of 2022, when the share price went from 23 towards the end of 2021 all the way down to about $12.50. So again, share price almost corrected 50%. So over the past 7 years, we have seen 3 times when the Lovisa share price has corrected 50%. And that could happen again over the next few years. We don't know. And if I do see that, that is when I will more than likely add to my position in this company. I plan to continue doing these Kneppy's analysis video series for a while yet. And the next 5 companies I'll be looking at include Cochlear, which is my next video. They released their half-year results, and the market liked it. Share price up something like 7%. Also looking at XRF, which is a smaller company on the ASX, but another potentially high-quality company. I have not done any research on that company yet, but just based off their chart, based off the profitability and increase in profitability of XRF over the last few years, I think that company is heading for some good times ahead. Also looking at Goodman Group and Centuria Industrial Property, CIP. I have never looked at a REIT before. You could probably argue that Goodman is heading towards that area, but Centuria is the first REIT I will ever look at. And Dicker Data. Main reason I've included Dicker Data is because after release of their half-year results, the share price has pulled back a fair bit. So maybe there might be some value in that company. I want to have a look to see if there is any value in Dicker Data. Another company I haven't done much research on in the past, but that has been a beloved stock on the ASX over the last 5 years. And maybe this is another instance of when a company share price does pull back, or high quality company share price pulls back, that's maybe the time to think about taking a position in that company. That's all I have for this video looking at Lovisa. If you disagree with me about Lovisa, if you think this is a low quality company, if you don't like Lovisa, if you have been into a store and absolutely don't like the products they make, if you think this company is heading for trouble, I'd love to hear any differing opinions, because hearing a different opinion, particularly if that different opinion is well thought of, insightful, can be quite humbling. And that's how we learn as investors, to take aboard different opinions and then sort of adjust our own opinions based off the validity of those different opinions. Maybe your different opinion can be completely wrong, and that's when I just totally disregard it. But if you have a really good, powerful, different opinion than my own, I'm going to listen to it. I'm going to take that aboard, and potentially I might change my opinion on Lovisa. At this point in time, it would have to be a very powerful counter argument for me to change my opinion on this company. So I'd love to hear it. So leave your opinion, your different opinion, in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.